On the eve of the budget, the economic survey projects growth conditions will be sluggish next year. Pegs FY26 GDP growth rate between 6.3 to 6.8%. Growth rate for the current financial year estimated at 6.4%, the slowest in 4 years. The survey warns India Inc. of wage growth moderation, even when corporate profits are at a 15-year high. Says it is in the enlightened self-interest of corporates to take job creation seriously. Also says the private sector needs to do more to boost consumption.
So deregulation is not just about ease of doing business, it is a pathway to employment generation.
The Chief Economic Advisor makes a big pitch for deregulation, asks governments to get out of the way and allow businesses to focus on their core mission. Says the government must stop micromanaging economic activity. The Economic Survey says India must guard against excessive financialization, also warns about the impact of artificial intelligence on jobs, says companies using AI to cut jobs are likely to face higher taxes. Budget session of Parliament kicks off with the President's address. The government has listed 16 bills besides the financial legislations related to the budget. Opposition sharpens its knives, calls for a debate on the economy and the Kumbh Mela tragedy, among other issues. Well, those are the big stories from Parliament ahead of the budget tomorrow. Good evening. Thanks very much for joining us on India Business Hour. I'm Shireen Bhan. The other big stories that we're tracking for you as we count down to the budget. Stock markets perk up ahead of the budget. The Sensex gains over 700 points. The Nifty reclaims 23,500. Both indices up 2% for the week, snapping a 3-week losing streak.
My response to competitors is I think they celebrated too soon. Yeah. Right? Let them bring their response to our announcements today. And we'll see. Market mein milenge unse.
Competitors celebrated too soon. It's game on, says Ola Electric's Bhavish Agarwal. The company launches 4 new electric scooters with a starting price of 80,000 rupees. Apple's revenues rise 4% in the December quarter, but iPhone sales fail to meet expectations. Tim Cook says the company is particularly keen on India as sales hit a record high. Nestle India meets estimates in Q3. Volume growth of 3% beats estimates, making it the first FMCG company to deliver higher growth in this quarter. US President Donald Trump poised to unleash a first wave of tariffs tomorrow. Trump has set February 1st as the deadline to impose tariffs on America's top trading partners, Canada and Mexico.
मां लक्ष्मी से प्रार्थना करता हूं कि देश के हर गरीब एवं मध्यम वर्ग समुदाय पर मां लक्ष्मी की विशेष कृपा रहे।
भारत की विकास यात्रा के इस अमृतकाल को आज मेरी सरकार अभूतपूर्व उपलब्धियों के माध्यम से नई ऊर्जा दे रही है। तीसरे कार्यकाल में 3 गुना तेज गति से काम हो रहा है। आज देश बड़े निर्णयों और नीतियों को असाधारण गति से लागू होते देख रहा है।
False promise.
Boring. No comment.
No, the poor lady, the president was getting very tired by the end.
Repeating the same thing again
No,
and
she
again.
could hardly speak, poor thing.
It is the eve of the Union Budget. Finance Minister Nirmala Sitharaman and the team at the Finance Ministry posing for photographs. The officials involved in the budget have been under a quarantine for the last few days. The budget session began today with the tabling of the Economic Survey, and that is our top story tonight. Let's take you through the key highlights of the survey by the Chief Economic Advisor Anantha Nageshwaran. FY26 GDP growth has been projected at between 6.3 to 6.8%. For the current financial year, the growth has been estimated at 6.4%, which is the slowest in 4 years. With the growth slowing down, the Chief Economic Advisor sent out a clear message to corporate India. The baton on capital expenditure needs to be passed on by the government to India Inc. and India Inc. needs to do more. The CA also pointed out that corporate profits are at a 15-year high, but wage growth is moderating. The CA says, and I quote, "It is in the enlightened self-interest of corporates who are swimming in profits to take job creation seriously," end of quote. But not just corporate India. The economic survey also has a word of advice for governments, and that is get out of the way. Allow businesses to focus on their core mission. Deregulation clearly has been the big central theme of the survey. It says that the government must stop micromanaging economic activity. And it's not just deregulation that the government has pitchforked as an idea. The survey also warns India not to ignore the impact of artificial intelligence. Over the next few minutes, our team of reporters will decode the key commentary from the survey. But first, listen in to the CA, who, without mincing words, has said that the private sector needs to do more to boost consumption.
The growth in profitability and the growth in employment expenses, which is a combination of hiring and compensation, there is a huge disparity between the two, which has been highlighted by several private sector players themselves in the last few months. And this happened even as Indian corporate sector profitability hit a 15-year high in March 2024. And some of you may have heard that when in the 1960s, when Henry Ford raised the minimum wages for his car workers, he said, otherwise there will not be enough people to buy the cars the Ford Motors produces. So in some sense, raising wage and salary growth for workers is also a source for aggregate demand for businesses in the medium run as well. So it is both, it is enlightened self-interest rather than being seen only from a moral prism as well.
The government can continue to take policy actions as it has been doing with respect to PLI schemes on labor-intensive sectors. And also in terms of the deregulation action, that is the government's, not just the union government, but the state governments and local governments' contribution to employment generation is by reducing the fixed cost of doing business so that firms can raise the variable cost by hiring more people. Beyond that, I think not everything needs a policy tweak or a policy intervention. Some of it is in the natural self-interest of businesses to be able to find this balance. And that is why I gave the example of Mr. Henry Ford.
The top corporate captains responded to the CA's call for aligning wage growth with profits, also reiterating the need for a capex hike. Listen in.
When wages are determined by inflation, it is determined by wage surveys in the market. They are not indexed to profitability. And because when profitability goes down, the reverse doesn't happen also. That's not the way it is done. And what we have to also look at the fact is when we are looking at wage growth, we are looking at an aggregate number. The fact of the matter is industry has become efficient and needs to do so to be competitive. The fact of the matter is there is certification of industry. A lot of components of manufacturing are now become to be done by specialized services agency. And that's what's happened across the world.
First, we would say stay the course on capex. That's been a plus in the budgets over the last few years, which is a focus on the multiplier effect that capex brings in and the positivity from an economy standpoint on that front. The second is there is clearly a need for some demand stimulation because we see weakness in the middle and the lower segments, and that's something that needs to be addressed in a pinpoint manner for them.
So Lata is standing by with her take on the survey and what we can expect from the budget tomorrow. Lata.
Well, as everyone has pointed out, the survey has a very modest assumption of growth in FY26. It's between 6.3 and 6.8. Exactly the range that I got when I did a poll before the economic survey. But for the budget, the more important number is the nominal GDP, which is real GDP plus inflation. There is no mention of that. But if the real GDP is modest, then looks like the budget will go with a nominal GDP of 10.5 or even less. That's just my guess. On reading between the lines to get what the budget may have on fiscal deficit, a direct question was asked to the CA in the conference, will you advise boosting consumption? And his answer, he just skipped the answer very nicely, saying that we are asking for deregulation. If governments deregulate, then private sector will create more jobs and more income, and that will boost consumption. So we didn't get anything on what the fiscal deficit will be, also, or whether there will be welfare measures. As well, he was asked about whether food inflation should go away from the MPC target. A point that was touched on in the previous survey. Again, the CEA said that he has nothing to say on the matter. What had to be said was said in the previous survey. So we didn't really get anything much in terms of directions for the budget or for the MPC. On state of growth, the government, the CEA was happy with the state of growth in the current year, saying that 6.4, first half was only 6%. So second half, clearly growth has picked up. And he pointed out that whether you take gross fixed capital formation or exports as a percentage of GDP or private consumption as a percentage of GDP, they've all come to pre-COVID levels. For FY26 itself, he was pointing out that food inflation is headed lower because of a good harvest, and the balance of payments can be comfortably met because of good remittances and because of good services exports. Long-term suggestions, of course, have been more deregulation and telling private sector to create more jobs and pay labour well so that more demand is created.
Now to the day's market action. Stock markets going into the budget on a positive note. The Sensex up over 700 points. Nifty reclaiming 25,300. Financials, though, marginally underperforming the blue chips today, with the Nifty Bank Index gaining 0.5%. Mid-caps outperformed the blue chips, regaining more lost ground. So the markets going in strong ahead of the budget. Remember, it is a Saturday, but the markets will be open for trade as the budget is revealed. Gold prices hit a record high today and on track for a fifth consecutive weekly gain. This after investors flocked to the safe haven metal due to heightened US tariff concerns. This also marks gold's best monthly performance since 2024. The yellow metal has also recorded highs back home in India. Competitor is celebrated too soon. It's game on. That's the word coming in from Ola Electric's Bhavish Agarwal. His comments come months after Bajaj Auto MD Rajiv Bajaj took a jibe at the e-scooter maker. While he was speaking at the launch event of his 4 new electric scooters, the Gen 3 models, Bhavish calls it the start of an introductory price of almost 80,000 rupees. He added the company had enough headroom for aggressive pricing.
So 30-35% is what I'm continuing to guide the street on. And if you see the last 2 weeks in January, we've actually been in that zone on a weekly level. We've been in the 30+ zone on a weekly market share level. And I think with all the new products, with the 12 products that we have now and the pricing, we should get there. And, if competition is aggressive on pricing, we have enough headroom to be aggressive on pricing.
I don't know if you heard Mr. Rajiv Bajaj at the CNBC-TV18 event saying, Ola to Ola hai, but Chetak to Shola hai. But the gap between you and your competitors right now is also very close. So what gives you the confidence you'll be able to, bridge this sort of in the coming months?
See, my response to competitors is I think they celebrated too soon, right? Let them bring their response to our announcements today, and we'll see. Market में मिलेंगे उनसे. Market में मिल ही रहे हैं, and we are back to number one.
Yeah.
And we have all these products, the technology. The incumbent ICE companies had a one-time advantage of distribution scale, which we have nullified now. Okay. And the product advantage was always with us. It has enhanced with our Gen 3 portfolio. And the pricing advantage also with our better cost structure is also with us. So I think game on.
Well, that's Bhavish Agarwal saying game on. Vedanta has pushed back its demerger plans by 3 months. The CFO Ajay Goel spoke with CNBC-TV18, said the demerger will happen between June to July this year against the earlier timeline of March. Take a look.
We have called for the meeting of multiple stakeholders. So be it creditors, lenders, or in fact shareholders on mid of Feb. It's 18th of Feb. And that is perhaps the most important stage. Thereafter, we also need a few routine government approvals. We see this entire transaction concluding by around June or July of the current calendar year. So it's mostly on track, couple of months here and there. So if you look at the parent company to begin with and the current fiscal first 9 months for the parent company, debt has in fact declined by 1 billion. And with that, the debt for the Vedanta Resources is down to 4.8 billion. And that is the lowest in last 1 decade. If we look at Vedanta Limited, and here net debt to EBITDA is the right benchmark, which has improved to 1.4x from 1.7. So in future, both debt for the parent company and Vedanta Limited will keep.
Apple's revenue has risen 4% in the December quarter. The company's overall sales and profits were boosted by stronger than expected sales of iPads and Macs. However, iPhone sales failed to meet expectations. Apple CEO Tim Cook has said the company is particularly keen on India as sales here have hit a record high. Earnings. Nestle India delivering Q3 volume growth is 3% ahead of estimates, making it the first FMCG company to deliver higher growth in the quarter. Profits up 5%, revenue was 4%. Margins contracted but still ahead of estimates. Marico's Q3 earnings in line with street expectations. Net profit in the quarter came in nearly 400 crore rupees. Revenue grew in double digits on a yearly basis to over 2,790 crores. Margin stood at 19%. And before we wrap, US President Donald Trump is poised to unleash a first wave of tariffs tomorrow. Trump has set February 1st as the deadline to impose tariffs on America's top trading partners, Canada and Mexico. Whether he will follow through or not is the big question. Well, joining me now is the man of the moment, the chief architect of the economic survey, the chief economic advisor, V. Anantha Nageshwaran. Mr. Nageshwaran, always a pleasure. Many thanks for joining us here on CNBC-TV18. Firstly, sir, congratulations on another economic survey. And I think the feedback that we've got from all quarters, economists and other stakeholders is very clear that the survey has always been realistic in its growth estimates and its growth projections. And that's the feedback that's coming in this time around as well. But if I may address the overarching theme of the survey, sir, and you've used the words deregulation and regulation over 350 times in the 480-page economic survey that's out today. So in the context of the government talking about unleashing of the animal spirits of corporate India, do we have a demand problem or do we have a regulation problem, sir? Has regulation continued to shackle the animal spirits?
Well, I think, Shireen, you have, as usual, packed a lot of questions into one statement, in one question. So it's difficult to unpack them. Look, I think it both don't have to be mutually exclusive. And deregulation or basically removing the fear of growth in our business enterprises has been an enduring issue over the years. And it's still, while much has been done in the last 10 years or so, both in the union government level and in state governments, much more remains to be done. And that could itself also address the demand problem, because it can sort of stimulate a virtuous circle of economic activity, leading to greater hiring, compensation, and income growth, and therefore demand growth as well. So they're not exactly mutual. They're not mutually exclusive. They are interdependent, and one can address both. In fact, I think addressing one of them may lead to addressing the deregulation aspect may actually also address the demand challenge as well, whether it is short term or medium term.
So let's address that issue, sir. And, you know, if I were to articulate the bucket list of industry asks, it's capex, it's consumption, and, of course, the focus is on corporate India as far as the government is concerned. Let's address consumption. How concerned are you about consumption growth today, economic advisor? You know, industry is saying more needs to be done, tax relief needs to be given, consumption vouchers need to be on the table. Let me ask you a straightforward question. Are you worried about consumption growth?
Look, the industry may have a bucket list of demands, some of which may be mutually inconsistent. So let's not go there. But in terms of consumption, look, last year we were speaking about the fact that last 2 years, 22, maybe 22 up to 24, there was a lot of conversation about K-shaped recovery in India, rural India lagging behind, etc. But now that is suddenly out of the window because rural India consumption story is doing quite well. So it turned out to be cyclical and not structural in that sense. Now, in terms of urban consumption growth, yes, you may call it a quasi-cyclical, quasi-structural issue. And again, the answer is not necessarily with respect to government, but also with respect to how things may have changed post-COVID in terms of the private sector's hiring and compensation practices. That has also a lot to contribute to the consumption slowdown we may have experienced. And more approximately, we could focus on the central bank's multiple macro-prudential actions, which were necessary at different points in time, but collectively they may also have contributed to a slowdown in credit growth, dampening economic activity, hiring. So in that sense, yes, consumption is an important pillar of economic activity, but
whether we should go all out and call it a serious structural issue, I have my doubts. I think it's a combination of both, and it is an outcome of multiple developments and not just one particular argument, but mainly one can look at post-COVID labor market practices in the private sector, near-term credit-related actions, etc. Those are important determinants of the consumption slowdown story. Back to you.
So, when you talk about the many factors that you believe have impacted consumption growth, economic advisor, let me again ask you a straightforward question. Do you believe that this is an area, given all of the fiscal space that the government enjoys at this point in time, that requires intervention to be prioritized?
Look, I mean, we are barely 24 hours before the budget is presented by the finance minister. Let's not speculate on it at this point. We can probably have this conversation a few days later.
Fair enough. Let me address the other C, sir, and that is capex. Now, once again, the government has been doing the heavy lifting, which has been acknowledged and articulated through the course of the economic survey as well. When you talk about the baton moving from the government to the private sector, again, I'll ask you this in the context of the industry wish list, 20% capex growth, 25% capex growth. I mean, are those reasonable asks? Are those reasonable expectations to have, given the fact that the government has been doing record numbers as far as capex is concerned? I want to understand where the position lies with respect to how we should approach the expectation on capex.
No, I think that's a good point, Shalini, you are raising. I think the slowdown in capex spending in terms of public investments is something that is straddling both the union government and the state governments. As far as FY25 is concerned, yes, there could be a capacity constraint with respect to spending on the part of the public sector. When I say public sector deliberately, I don't use the word union government, use the words union government. I'm referring to the entire public sector, which includes state governments also. So therefore, there is a need for the private sector to look at the need for ramping up investment and its implications for demand, because ultimately, in an economy, it is the private sector that is mutually endogenous. Private sector consists of both households and enterprises. Public sector, fiscal policy, and external demand, foreign trade, both are exogenous to the system. So the private sector can actually do a lot to stimulate demand and thereby justify its own investments. And that is where they need to focus on. Otherwise, asking the government to ramp up capital investment, lower taxes, keep interest rates low, and maintain low fiscal deficits. These are not mutually consistent set of recommendations or asks on the part of the private sector.
So would it be fair then to say that, and the survey says that, yes, the government needs to continue to spend on infrastructure development, not just over the next year or 5 years, over the next decade to achieve the kind of growth rates that we aspire to. But would it be fair to temper then the expectations of the way that we look at capex-driven growth, especially on the part of the government?
Sure, I think so. I think infrastructure investment, both in terms of renewals, both brownfield and greenfield, would be necessary. But again, as you correctly put it, the way we look at it, we need to therefore go back to the public-private partnership model and how that can be reinvigorated, because the demands on public resources from various investment angles, not just physical infrastructure, but related to energy transition, related to soft infrastructure, etc., will always be there, given our size. And that is something we need to bear in mind. And that is why how we approach this, as you correctly put it, will have to change. Shireen, I think we have to end here.
Let me ask one final question, CA. And, again, the thrust of this survey has also been on the onus of the private sector. You talk about enlightened self-interest of the private sector to do more, to stimulate jobs, to stimulate demand. I don't want to put words in your mouth, but I want to ask you, CA, is there a sense of frustration? Is there a sense of disappointment? You talk about the corporate sector swimming in profits, about the private sector not having lived up to its end of the bargain. I'm not putting words in your mouth. I'm asking you to comment if there is that sense of frustration and disappointment.
No, not at all. Not at all. There is no question of frustration or disappointment because economy and economic activity is an ongoing phenomenon. And what I'm writing about is an ongoing thing. It is not something that we expected them to act within a particular time frame and they didn't act and therefore there is frustration. But what I'm writing about is valid today, will be valid 5 years later, will be valid even 20 years later. So there is no question of frustration or disappointment creeping in, but it is to stress the fact. I mean, if you look at the survey, we do write about the fact that in post-World War II Japan, there was a compact between the government, the private sector, and workers that basically made the economy transform itself into a first world country. And that is the kind of compact that we should be having in this country. We wrote about it in July as well, and that is what we are expanding on at this time. So as you correctly said, you are not putting words into my mouth, and I didn't utter those words either. And these are natural, ongoing obligations on all sectors of the economy for medium-term growth. There is nothing to be frustrated or disappointed about at this point.
Well, economic advisor, we would love to continue this conversation, but I know we're out of time. We look forward to speaking to you tomorrow when we can speak much more freely as the budget is revealed, and we will go over the numbers with you. But always a pleasure. Once again, congratulations on the economic survey, and many, many thanks for joining us here on CNBC-TV18. That's V. Anantha Nageshwaran, the Chief Economic Advisor, on the highlights and the prescriptions that the economic survey puts out. We will take a break, but there's a lot more coming up. Don't go anywhere. We're back in a moment with more.